So looking ahead to this week starting December 2nd, we're now in the final month of 2019, so naturally at this stage of the year, investors start thinking ahead to what 2020 could bring. But still in the short term, we've got two big events to look out for that we'll be focusing on, and that's the OPEC meeting and the non-farm payrolls release, that's the US unemployment report. Now, as far as our market's backdrop leading into this, we said in the previous video that we're probably on the cusp of seeing a rebound in equities and new all-time highs. That happened in Monday, so it literally happened at the start of the week. And so that prediction came to fruition pretty quickly, but we've been meandering really since then. We had a couple of record highs in the US, but we pulled back, and it's mostly related to the trade tensions, but obviously we had the Thanksgiving holiday last week as a bit of a break as well. So now full throttle trading again. It remains to be seen what investors are going to do and whether we're going to see the kind of profit taking that we saw last December. Now, outside of equities, there's not been too much to report. We did see a 6-month high in dollar yen, but otherwise the volatility has been quite muted. We saw a big drop in Bitcoin falling below the 7,000 level, which has since acted a bit of support. But outside of that, volatility has been pretty compressed, and I think you can probably attribute it to the latest actions from central banks. Now, as normal, we're going to have a quick run through of the economic calendar, and then I'll discuss those that OPEC meeting and the NFP numbers. So it's actually quite a big week for data, as is normally the case after a holiday week in the US. We kick the week off with manufacturing PMIs from China, Europe and the US. Germany and the US are still both in contraction territory, so from that data we're really just looking for some stabilization. A move back into expansion would be a clear shock and would be a good risk-on result, but it's still unlikely. We've got interest rate meetings in Australia and Canada. And we round off the week with the OPEC meeting on Thursday and Friday. It's a 2-day meeting. And the non-farm payrolls data, as always, is the first Friday of the month. So that's out on Friday. Now, oil prices have been up 14% in the last 2 months. So actually a pretty decent run for oil prices. That comes after a very volatile September, which, if you remember, we saw some rapid optimism that a trade deal would get done, followed by some and also a rapid run-up in prices relating to that drone getting shot down in Saudi Arabia, and then the strike on the oil plants. So there was some Middle Eastern tensions there, geopolitical tensions were moving around the oil price quite a lot. And really in the last couple of months, people have been positive on the oil price, generally the feeling that a trade deal is going to get done, and that's good for oil demand. But still, even with that 14% gain, we're kind of flat over the past few months in oil prices, and we're pretty much in a trading range. So then the question obviously comes, is this OPEC meeting something that can get us out of that trading range? Well, probably not is the answer. If we talk about what we're expecting here, we are expecting that OPEC, it's not just OPEC, remember these days it includes Russia and some other non-OPEC nations, which we refer to as OPEC plus. They all look like they're going to maintain output cuts. So the problem with that is that they only started these output cuts when production was already pretty much at record levels. So we've got near record levels of output in Russia, Saudi Arabia and the other big Middle Eastern nations that make up OPEC. And we've also got record output from the US. So supply is very high for the oil market. And clearly when supply is in excess, that limits how high the price can really go, even when there are tensions in the Middle East with the likes of Iran, etc. On the demand side, we've got the trade war. So that's a massive risk overhanging global growth. But there are some bets out there that actually we can see a bit of a global growth rebound next year, in part thanks to lower interest rates. And so if that's the case, that's good for oil demand. So you can kind of see why oil's in a range. Supply is pretty excessive, but actually demand should be holding up. And so the biggest risk is probably to the downside, but it would be more relating to the trade war than it would be some action taken by OPEC. Now, just to say, there's some outside chances would be that if OPEC cuts by more than expected, that would be a big positive for the oil price. If they actually choose to pause the policy and actually revert back to a policy of not having these cuts in place, that would be a big negative. But that seems unlikely, although while US production keeps increasing and taking more market share, that possibility does actually increase. Now, the other thing we were going to talk about is non-farm payrolls. So if you remember the figures last week, I have to have a double check. It was 128K last time around. That was actually better than expected. It was 105,000 expected. This time around, again, double checking here, it's 183,000 is what we're expecting. That's above the annual average for 2019, which is 167,000. That's just interesting because obviously Donald Trump's big pitch is that he's creating jobs, particularly in the manufacturing sector, but actually that hasn't really come to fruition. In 2017 and 2018, the average monthly gain for the year was over 200,000, now it's 167,000, and we've seen a big exodus of manufacturing jobs most recently. You can't attribute it all to the trade uncertainty, but clearly that's playing a role. So all that being said, given the importance of these jobs numbers politically going into the 2020 election, I think generally we're going to see more interest in these job numbers, and we've actually seen more volatility in the numbers, not just at 200,000 every time. They've been absolutely varying. So I think the reaction in markets will make this a bit more of a tradable event. At the moment, I think from a dollar standpoint, the dollar always rises if the numbers are better than expected, or falls if they're worse than expected. From a indices standpoint, I think we're at the state of play where bad data would be bad for indices, just because the Fed are on hold. Jay Powell in his recent statements has said it would require a substantial change in the economy for them to cut interest rates again. So if there's some really soft data, the Fed aren't going to be there to give markets that extra cushion. So that's why you could see a big sell-off in markets if there's another big miss. Equally, if it comes in as or above expectations, more reason to add to these record highs that we've been seeing lately in the US indices. So that's it for the video this week. Thank you very much for watching, and if you do enjoy these videos, please make sure to follow myself and LCG on YouTube and social media.